Hello and welcome to G Fun Facts Online. Have you ever wondered why the price you pay for gas can swing so wildly from one month to the next? You might think it's all about supply and demand, but there's a hidden, shadowy figure pulling the strings in the world's energy markets. It's called the geopolitical risk premium. Think of it as a global anxiety tax on every barrel of oil, a price we pay for fear and uncertainty. Today, we're going to unpack this complex idea and see how events happening thousands of miles away can directly affect your wallet. So what exactly is this geopolitical risk premium? In simple terms, it's the extra money that oil traders add to the price of oil because they're worried something bad might happen. A conflict in a major oil-producing region, a political standoff, or even just the threat of sanctions. All these things create a risk that the oil supply could be disrupted. To account for that risk, the price goes up. It's the market's way of pricing in fear. But here's where it gets really interesting. Geopolitical tensions are a two-sided coin. They don't always push prices up. First, there's what economists call the economic activity channel. When global tensions rise, people and businesses get nervous. They spend less, invest less, and global trade can slow down. This economic chill reduces the overall demand for oil, which can actually push prices down. But then there's the other side, the risk channel. This is the fear we just talked about. The risk of future supply disruptions makes holding on to physical oil right now very valuable. Traders anticipate shortages and bid up the price, creating what's called a convenience yield. So you have this constant tug of war, economic slowdown pushing prices down, and supply fears pulling them up. History gives us some fascinating examples of this push and pull. Take the 9/11 attacks. The initial shock caused a 5% spike in oil prices, but within 2 weeks, prices had actually fallen by 25%. Why? Because the bigger fear wasn't a supply cut, but a massive global economic slowdown that would crush oil demand. Contrast that with Russia's invasion of Ukraine in 2022. That event sent Brent crude prices soaring by nearly 30% in just 2 weeks. Here, the immediate fear of a huge chunk of global supply being cut off far outweighed any concerns about a future economic slowdown. Of course, we've seen this throughout history, from the 1973 oil crisis to the Gulf War, where political events triggered major economic turmoil. So what does this risk map look like today? It's a complex mess of interconnected threats. First, the Middle East is a primary source of concern. Tensions involving Iran and the conflict between Israel and its neighbors mean the Strait of Hormuz, a tiny waterway through which a huge amount of global oil travels, remains a major vulnerability. Analysts estimate that the current tension is already adding a risk premium of about $5 to $10 per barrel. If that strait were to be fully closed, some predict prices could skyrocket to $120 a barrel. Then there's the ongoing war in Ukraine. Sanctions and embargoes on Russian oil have permanently altered global supply chains. Shocks coming from Russia have been shown to have a longer-lasting effect on oil prices than shocks from other regions. And it doesn't stop there. We also have to factor in uncertainty around OPEC production quotas, attacks on shipping in the Red Sea, and political instability in various other oil-producing nations. It's a long list. How does a headline about a conflict translate into a higher price at the pump? It happens in a few ways. The most obvious is direct supply chain disruption. A damaged pipeline or a blocked shipping lane physically stops oil from moving. Then there are the indirect costs. Insurance premiums for oil tankers traveling through risky waters go way up. Ships might have to take longer, more expensive routes to avoid conflict zones. All these costs get passed down the line. Finally, there's market sentiment and pure speculation. The perception of risk is often just as powerful as actual risk. Traders hedge their bets, investors react to instability, and this flurry of activity can amplify price swings. It can become a self-fulfilling prophecy, where the fear of higher prices is exactly what drives them up. So what does the future hold? Volatility. That's the one guarantee. Forecasters at Goldman Sachs expect oil to trade somewhere between $70 and $85 a barrel in 2025, but they're quick to add that any major geopolitical event could easily shatter that range. The future of this risk premium will depend on how major conflicts in the Middle East and Ukraine evolve. It will also depend on the decisions of the OPEC Plus cartel, which holds spare capacity that can act as a buffer. In the long run, the global shift to renewable energy should reduce our dependence on oil and lessen the impact of these geopolitical games. But in the medium term, the transition itself could create its own new instabilities. The geopolitical risk premium isn't just a number on a trader's screen. It's a reflection of our deeply interconnected and often fragile world. It's a constant reminder that politics, conflict, and economics are woven together, and a flare-up in one corner of the globe can be felt by all of us every time we fill up our cars. Understanding this shadowy figure in the oil market helps us understand the modern world itself. Thanks for tuning in to Fun Facts Online.